This week's update is this peak inflation, what to look for and what to expect from here, and gold surges. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Now, as I mentioned a couple of weeks ago, one of the key reasons that I've been doing these videos for a long time is that it's not very difficult to lose money in the stock market if you don't have a plan and you are responding to the news and just generally doing things the way that our psychology would normally dictate. Then you can still lose money in the market, even in the most advantageous conditions. And certainly this year has been extremely difficult. But the key is to be getting organised and to give yourself the best possible chance that you can. Right, now I said that I wasn't going to be recording a video whilst I was on holidays, but the market reaction to the inflation data on Thursday night has caught many investors completely off guard because it was just such an amazing reversal. And now I'm a bit confused about how they should proceed. So I've taken a bit of time out of the end of my holiday to record this video because I just think it's such a pivotal point at the moment. So basically, couldn't help myself. I've been doing these videos for a long time, nearly 15 years, and the purpose is to provide a timely perspective on the signals that are very important in the market, and I think now is one of those times. So let's get into it. So as early as March this year, I've been saying that one of the key signals we needed to look for was a slowing in the rate of inflation. That is, that the Fed rate rises were starting to take effect. And it's taken a long time for that to manifest itself, but it's possible and maybe even probable that the first of those points in time occurred on Thursday night. That the Fed rate rises to date are starting to take effect, and inflation is starting to progress, but at a slower rate. Now, markets always get too pessimistic about things, and they price in too much downside, so they always tend to overshoot to the downside. So because markets are forward-looking, whenever they get any sort of sniff at all that things are getting, let's call it, less worse, then they're going to take off. And that is exactly what we saw on Thursday and Friday, which I'll get to in the charts in a minute. Now, some parts of the market have been pretty much unaffected in 2022. Energy has been tremendous. It's gone up a lot, particularly in America. Battery materials have done extremely well, particularly lithium. And so if you were overweight in those areas and maybe had a bit of hedging in place as well, then you've probably been in pretty good shape. And that's largely how myself and members of my services have gone this year. But what is that now done? What has Thursday and Friday now done to the market? So let's start with a bit of perspective, and then we'll get to the charts. Look, it's a great start. Two really emphatic days, and when you look at it at an individual stock level, a lot of very powerful moves, big price moves confirmed by major volumes as well. We've seen the QQQ, which is the ETF that tracks the NASDAQ. It's set higher highs and higher lows, so that's the makings of an uptrend. We've had that several times during the year in March, April, and again in the middle of the year, and again just recently. But even more important than that is the NASDAQ and the semiconductors, which is SMH, is the ETF that tracks the semiconductors. And those ratios have started outperforming dramatically. So, that to me is more important than the indices setting new highs. It's where the money is going in between sections of the market. And what that is saying is that money is now flowing back into semiconductors back into the more aggressive sectors of the market in preference to the more defensive areas. And you really need to see that for the bull market to get back on track. There's a lot of individual stock moves over the last 2 days in America that have been extremely emphatic. However, it's possible, look, I'm sure there is an element of short covering. To what degree, we won't know for a few weeks. But let's assume that there's some short covering there to either a small degree or a large degree. Now, if it's just short covering to a large degree, then I'm a bit nervous about whether this rebound is the real thing. I believe it is, but I'm just keeping my options open. So what I would like to see is the QQQ breaking the 200-day moving average. That would be positive. And also the pullbacks that there will be, and there will be some, are fairly small, and the obvious support levels that they're pulling back to hold. So that's the key things that I'm going to be looking for. But look, as I said in the last video 2 weeks ago, I actually don't care too much what the individual indices are doing. I'm just watching, my target stocks and managing them to the best of my ability. And I think if you do that, it doesn't really matter whether we're in a bull market or a bear market or what the indices are doing. Right, before we get to the American market, let's look at some charts. This is SMH, and I've been showing this chart for a long time now throughout much of 2022, and always making the point that semiconductors need to do well for the next bull market to emerge. And certainly, as you can see, we appeared to have bottomed out, had moved up nicely, but nothing definitive there. But look at the last 2 days. Look at Thursday and Friday since the CPI report. That's very powerful stuff. And that's, that's become one of the strongest parts of the market. And look at the volumes as well. So, that is the most encouraging thing that I saw over the last couple of days. And that is indicative that money is moving back into semiconductors in a major way. Just while I'm here, let's just look at this copper chart. I'll come back to copper later, but this is a chart that I haven't been showing. I discovered that it was in Optima, didn't know it was there, but I'll be probably referring to this more often. So this is the big picture on copper from, here's the lows at the bottom of the COVID crash in 2020. And so that was around 13 on this ETF. The peaks were around about 29.30. And then we got virtually an exact 61.8% retracement of that gain. And now we've formed higher highs and higher lows. And you can see quite emphatic move, particularly on Thursday and Friday. Big gaps, big increases in volumes. So, this looks extremely positive for copper. Just look at the main indices just for the record, and here's the S&P has now moved above the shorter term moving averages. The 20-day is just turning up and just getting above the 50. Hasn't made it through the 200 yet, but watch this space. That's been a pretty powerful move on big volume. If we look at the QQQ. You can see what I was talking about there, higher highs and higher lows, and we've now got a breakout above these two prior peaks. Again, not quite as advanced as the S&P. It's only just above the 50, and it's further away from the 200, so it's got more ground to make up. But the important thing is the ratio to the actual S&P. Let me just find that particular chart. I'll find that one first, because that's the one I'm after. Okay, so there's the NASDAQ 100 against the S&P. You can see it's been looking very, very ugly. A lot of that has been because the Googles and the Amazons and the Apples and all those stocks have been getting sold down so hard. Facebook, But you can see very, very nice reversal over the last couple of days. Let's hope that holds. But a more important indicator for me is this one. So this is semiconductors versus the S&P, and you can see just this reversal started before Thursday and Friday. So we're already starting to gain some significant momentum in semiconductors relative. So this is a relative chart, not an absolute chart. So it's just how it's performing relative to the S&P. Now the S&P had a great couple of days, and so did the Nasdaq. But look at semiconductors; they absolutely killed the S&P, which went up 6% anyway over the last couple of days. So that's just how powerful that move was. So that one's a really, really important chart. Let's get back to the other spread charts. I'll leave the gold ones for now. This is US mid-cap growth versus the S&P, and you can see that we seem to be getting back on track there as well. Semiconductors, this is consumer discretionary versus consumer staples. Discretionary been getting absolutely smashed. Did stage a big reversal. Now I'm always a bit wary here because Amazon and Tesla make a significant contribution to the discretionary index. It's something in the order of 35–40%. So I'm not getting terribly excited about consumer discretionary. And I'm actually very wary about consumer discretionary because, I think the probability that we go into a recession in the States is there. We're probably going to go into a recession in Australia, either officially or unofficially. So it's just not a sector that I can get excited about. This is the Nasdaq versus the S&P. So you can see turned up very nicely over the last couple of sessions. 1,000 Russell 1000 growth versus 1,000 value. So more sort of mid to large cap stocks. That one looks pretty good as well. So we're not out of the woods yet. We'll go back to the points that I made earlier about what I wanted to see out of the QQQ, but it's certainly a tremendous start. Let's look at the currency. Now, this is because of the inflation report. We'd had a bit of consolidation in the US dollar index. This rise just couldn't keep going, but the inflation report absolutely punctured it. Pre-report, we were looking at the US dollar being above 110, and we finished the week 2 days later at 106.5. That's 4 cents. That's a big move, very big move in currency terms. Of course, that's had the opposite effect on the Australian dollar, and the Australian dollar has rocketed back up to 66.5. So some very, very substantial moves there. ASX 200, quite a handy move on Friday, and I would expect that there'll be plenty more on Monday. I would expect, however, markets can do funny things. But as I said earlier, this is still a market where you don't want to just plunge in on the assumption that because we may be back into a bull market again that you can just buy anything, because I'm absolutely convinced that that's not the case. You've got to be extremely selective in what you go into, and members are certainly getting that in spades in the last couple of days, and that's going to continue in both my services, Portfolio Analyst and the Insiders Club. That's going to continue in coming weeks. So it's a pretty exciting time. As I said 2 weeks ago, I was excited about the market a couple of weeks ago. So just to summarise, the S&P up only 6% for the week. The bond market certainly appears to be pricing in peak inflation because we saw the 10-year yield drop quite sharply. There's probably a bit of short covering in there. I'm sure there'll be some of that. There's many other aspects that are confirming, as we've just seen from the spread charts. The US dollar index 106, the 10-year yield 3.82, so that's quite a dramatic fall from I think it was about 4.15 at the start of the week. So that's a big move. The VIX has also been hovering above and below 30 for quite some time now. It's dropped now to the low 20s. So the fear came out of the market very, very quickly. In terms of predicting a recession, the 10-2 spread, the yield spread between the 10-year and the 2-year, is still up there. In fact, got bigger to 0.52. So the bond market, whilst it did come off considerably, the difference between the short and the medium-term yields didn't, in fact, actually got a bit wider. So the bond market is certainly saying recession in America, that's for sure. And that's why stock picking is so important. You know, you just in a recession, you're just not going to see the whole market go up. It doesn't matter what the inflation report says. Aussie Stocks 66.39 was our dollar. Our index 3.9 for the week. Commodities and energy stocks have done really well, particularly the battery materials commodities and in energy. They've remained strong throughout much of 2022. There's been a few hiccups. The famous Goldman Sachs report about lithium punctured sentiment there for a little bit, but that has certainly quickly regained momentum. So they've done pretty well all year. There are some niche large caps that have turned around sharply in the last couple of days, and I've put them very much on members' agenda in the last day or so. Precious metals, gold, a huge week, $89 to $17.71 for the week. That is a big, big move in gold. Translated into Australian dollar terms, a little bit of a move, but not that much, because obviously our dollar went up as well, so that kept a lid on it. But look, that is still extremely profitable territory. Gold set a new short-term high, as we'll see from the chart in a minute, so hopefully that's a sign of the things to come. GDXJ, the US index for global gold stocks, which I think is more relevant now than GDX, that index was up 11%. But if we look in Australia, Evolution Mining up 30%, Regis Resources up 27%, Northern Star up 22%, Newcrest up 16%. A huge week for Australian producers. But as I've been saying all along, for probably 2 years now through this bear market in gold, that the place that I want to be is not in producers, but in world-class developers, emerging producers, because you can get some significant uplift in the share price without the need for the gold price to go up as well, because the project is being de-risked. And so therefore you get share price gain through that mechanism. And that's always been my preferred place to be, because, frankly, I just haven't trusted the gold price, and I still don't. So I think that's a much more attractive reward for risk area of the precious metals market. Let's take a peek at, by the way, just on Bitcoin. Absolutely smashed. If you're involved in the Bitcoin market, you would know that. We fell from 22,000, got down to under 16,000. So a right royal smashing there, and the crypto market is in considerable difficulty at the moment. There's the gold chart on a daily basis. You can see we've set now a new short-term high, and that's been a very, very emphatic move. And if we look at it on a weekly, the vital support of 1680 got broken, but we didn't really go that much further to the downside. And then you can see just what a week it was, quite extraordinary. And silver, not so much. So definitely a week for the gold bugs, that's for sure. Into other commodities now. Copper had a strong finish to the week with the US dollar falling. Nickel also very strong, getting back towards $12. LME copper inventory now is sitting at less than 2 days, which is record lows. Copper really should be trading higher, and perhaps from here it will. Now that the drag of the US dollar may be removed. There are certainly there are rumours around, and that's all they are at this stage because China is very unpredictable. But there are rumours around that China may soften their COVID restrictions, and that certainly fired up base metals. Now, I'm not placing a lot of stock in that because, I think China is a master manipulator of the media and the message. So I wouldn't proceed on that being a factual thing. But for me, the long-term supply-demand situation for copper and for nickel and for lithium and graphite is extremely attractive. Crude oil also rose a little bit to almost 89. Looking at the charts, you can see there the gain we had in spot copper, but the previous chart I showed in Optima shows it more clearly. If we look at the inventories, this is a 6-month copper warehouse levels. We're really down to very low levels now, 80,000 tonnes. If you look at it on a 5-year basis, we're basically at 5-year lows. So that's the situation for copper, and that just has to lead over the medium to longer term to higher prices. There's the nickel chart, managed to work its way higher, and if we take out this big spike back here earlier in the year, that took a fair while to unwind. Where if you put this on top of this little trend here, we're still in a very nice uptrend in nickel. There's the 5-year LME warehouse levels, also at basically at 5-year lows as well. So wherever you look in commodities, the inventory levels are low. The supply and demand situation is just getting more attractive. So the outlook over the next 5 to 10 years for many commodities is looking very solid. Wrapping it all up, should we expect from here? It's going to remain a volatile market. I'm convinced of that. It's also going to be very much a stock pickers market, and my focus would probably be on less than 15% of the market. But I'm extremely targeted, and I think that's certainly justified. Don't rely on the index or expect a rising tide to lift all the boats, because I'd be just staggered and dumbfounded if that happened. I just don't think it's going to happen at all. I think you absolutely need to be an astute stock picker and have a clear plan. And, it doesn't take a lot of time. Once you've got your plan in place, you don't have to be sitting on a computer all day. Once you're organised and you know what to look for and you're clear about your operational plan, then, it's all pretty straightforward. We've had great success stock picking in Australia this year. I'm hopeful, very hopeful, that the US may be joining the party, because the last couple of days on an individual stock level were really, really strong. Follow analyst last week was a Taking Stock edition last week, which is a once a month skills building session that I get very positive feedback from members about. Now, over the next couple of weeks in both Portfolio Analyst and in the Insiders Club, I'm going to be covering my highest conviction stocks, and I've got a lot of them, for both short-term and medium-term purposes in both Australia and the US. And, of course, answering members' questions about how to proceed, how to get in, how to manage, and how to take profits or losses if appropriate. If you want to take advantage of that, there's a $1 trial for 2 weeks. That gives you access to all my current thinking, but it also gives you access to more than 250 hours of educational content, strategy, and stock ideas, and some wonderful stock ideas come through on stocks that I've never heard of. So it's a real positive where members can jointly benefit from each other. The services suit investors and traders of all experience levels, and if you're not sure and you want to discuss it with me before you join, even though joining only costs $1, my email address is at the end of this video, so I would encourage you to do that. And there is that email address. More information on my website, and it'll be fascinating to see what happens in the following week. Just how much follow through we get. So that's it for this week. Cheers.